I'm Head of Marketing for AFTA, and I'm very pleased to have on the phone with me today two Stephens, Stephen Heller and Stephen Bushell, both from DFK, who are going to be hosting today's webinar. So, hey guys.
Morning.
Morning. Okay.
Before I hand over, I'm just doing a little bit of housekeeping. Just want to let you know that you are all on mute, but we will have a dedicated question and answer session at the very end of the webinar. You have a little toolbox there, and so we invite you to write questions. Feel free to write them as the webinar goes, and then when we get to the end, we'll address those. The webinar is also being recorded, so it will be put on the AFTA website so that you can revisit it or even download the slides and review that in your own time. Before we kickstart, I just want to just make a short announcement for those that may not have heard, but AFTA has officially launched the AFTA Insolvency Chargeback Scheme, also pronounced ACIS. Now, this scheme is available to ATAS accredited travel entities, and it's the first scheme of its kind for our industry that provides protection for travel agencies against credit card and debit chargeback. If you would like to find out more information about this, then visit afta.com.au/ACIS. So that's AICS for the AFTA Insolvency Chargeback Scheme. We encourage you to contact us, find out more about this. It is a fantastic scheme which is at no cost to you, and the ins and the outs of that scheme can be found on the website or simply by calling us. So please do inquire. This is something that AFTA has worked very hard to deliver to you, and it complements nicely our accreditation scheme. So this is the last webinar in the series of DFK, so I'm really pleased now to hand over to the guys who are going to take us through succession planning. Over to you guys.
Thank you, Joe. Okay, well, you've been, we're your presenters. And what we're discussing today is succession planning. Succession planning is a process for identifying and developing new leaders who can replace old leaders when they leave, retire, or die. And so our goal today is to assist you to explore your options, confidently navigate the potential pitfalls, and create a clear action plan for the implementation of a succession plan. So this is what we're going to cover between myself and Steve Bushell today. What is a succession plan and why every business owner needs one? Exploring the internal and external succession options. Appreciating the essential steps involved in developing a strong plan. Discovering the major challenges you will face and how to overcome them. Navigating the tax and structure implications. Understanding core business valuation guidelines, and creating an action plan to move forward. Now, we'll provide more information on it at the end, but as part of the people attending today, or I think it's also for those who are listening in, after this webinar, you will receive an email from AFTA, which will allow you to have a free succession plan consultation. Okay, I'll hand back to Joe. We just want couple of quick polls, and this is so we just get a feel of what sort of people we have in the audience. Okay, Joe?
Great. Well, our first question is, are you considering implementing a succession plan? And we just want to get a gauge for what sort of period that you might be thinking about implementing one. So the poll should have popped up on your screen, so start filling out that and I'll announce the results shortly. Interestingly, at the moment we've got about 5 years is winning at 51%. Just another moment and we'll see what the result is. Okay, so it looks like the majority of people on today's webinar are looking at implementing a plan within the next 5 years at 54%. We then have, interestingly, both 2 years, under 2 years, and plus 5 years, both sitting at 23%. So a few more votes rolling in, but yeah, so 55% within 5 years. So it's quite good that you're all on the call looking ahead. Okay, I'm now going to go to the next poll that we've got. Let's have a look at this one. Who is your succession plan likely to involve? Any ideas? Okay. Another minute or few seconds and we'll see what the results are for this. Okay, so Stevens, plural, what we've got is 42% are likely to engage an external purchaser or involved, followed by 26% existing staff, followed by 14% at this stage. I don't believe I can pass, and I can't read the end of that. What have we got? Pass the business on. That's interesting. And then 12% a family member, and then just 7% perhaps another type. Okay, back to you guys.
Okay, so interesting enough, most of you who have said in the next 5 years, so with that sort of decision, a lot of you have time to be able to work on something. I mean, there are obviously still 23% who talk about in 2 years. If you haven't got a plan, you've really got to start working on it. And it's also interesting that a large percentage of you want to look at selling out. In other words, going somewhere completely different from what the people you've got involved at the moment. So, first focus area is, what is a succession plan and why every business owner needs one? Okay, we all need to look to the future and build a business towards a logical transition. And again, we're of different ages. Some of us are really nearing the time we want to either have to get out or want to get out. So timing obviously will vary. And again, those people in that 2 to 5 years have time. The people in the less than 2 years, if you haven't really started thinking about it, you better get your act together. Or the answer is you're not going to have anyone to be able to take it over unless you have someone knocking on your doorstep. So things change rapidly, not just for business we're in, but the demand upon us personally. And you'll all discover this, obviously, especially now with the internet, etc. So don't leave it too late. We need to be able to handle this now. You've got to be able to work it out. So I suppose what we're looking at is, are we actually business people, or really are we just a slave of our own business, which means we're working in a job? And that makes a big difference when you want to get out. Growth, and this is where growth comes in. Growth requires staffing. And at some point, these people will look to the owners for a growth plan that might involve succession. You might have key employees that are really good, but if they can't see a future in your business, especially if you are at the older age group, They could very well move on and you've lost them to be able to be part of your future business. So look and use them if that is your aim. Try and sell to your existing staff, use them. And again, don't then suddenly turn around and say, oh, I've lost my best staff. They've gone to the opposition because they had a future. Now, this is not just the travel industry. This is in any business. Steve and I would know very much it's the same problem in the accounting business. You know, you've got to nurture your good staff. And if you really think they're the future of your business, use it. Now, what you've got to also look at is, what have you got for when you retire? Are all your assets tied up in your business? Or have you managed over the years to put funds aside so if the business can't sell, or you really don't want to sell it, that you've got enough assets? If you are relying on your business to be your retirement bundle, you just need to work on that now. Do we know what our business is really worth? Now, that's the big question. Now, different industries have different criteria for judging these. I don't know to be sure what travel agencies. I don't think, from what I can work out, too many of them sell. I know you have some of the bigger chains that might be looking to take over, but if you have you have to find out what your business is worth before you start working on any plan. So now I'll pass over to Steve.
Thank you very much, Steve. Welcome everybody, and great to have you everybody here. The next topic that we're going to cover is exploring the internal and external succession options, two very distinct and different paths you can take. And I guess when starting out to build a succession plan, in the first couple of steps, what we would certainly suggest is an audit of what you have is vital. Before you go looking at what we've got externally, let's at least cast our eye inwards to see who we have in the business. And interestingly, 42% of you are saying external purchaser, but equally 38% of you are saying external existing staff or perhaps a family member. So in that respect, it's pretty neck and neck as to external and internal. So one of the questions you can ask yourselves is, can I sell internally? Will you be leaving the business to your next generation? If so, what does that look like? Is there a ready market externally? We were talking earlier before we started this that there's a number of aggregators that are out there looking to buy up travel agents. Perhaps that is a ready-made market for you. All these questions and more need to be asked and answered quickly before moving forward. So we'll now look at a couple of the internal and external points to consider. And the first point under internal is, and I'm sure you've heard this plenty of times before in many aspects of businesses, what seats on the bus do you have, and are the right people in those seats? And part of this internal process, and the initial audit process you'll be doing, is ensuring that you have the right seats on the bus, because it's pretty important to make sure that when you're looking to either sell internally or externally, you've got all bases covered. Are there any operational gaps in your business that need to be filled to complete the business model? Perhaps you also have been stalling employing somebody, putting it off because it's an extra cost that you don't want to bear. When you're trying to sell your business internally and particularly externally, you want to put your best foot forward. So perhaps it's now time to bite the bullet as such, employ that extra person, that manager that perhaps might cover your role, or just fill that gap in the service offering that you have. This will give you the best chance to sell your business for the highest value if you've got all bases covered. Do they need to be employed now? Is there a general manager that needs to be employed? Perhaps a CEO to come into your business? An operations manager, as I said, that might need to cover some of your time, considering that once you sell, you'll no longer be there. All of these questions need to be answered in the beginning of the succession planning process, because without the answers to these questions, it's very hard to get the crystal ball out and really look at what your business looks like upon selling. Who's going to replace you is a vital question. If you are the business owner, there's no doubt that you've built up your travel agent perhaps from scratch, or you've bought it previously from somebody else. You're probably the key person in this business. Who's going to replace you, and what does that look like? Are there skills that you have that perhaps others don't have? Obviously, you may have many years of experience and history with your clients. Transitioning those clients across to others so they no longer rely upon yourself is a vital step. All of these things need to be considered when looking at the succession plan. Once all these seats are confirmed and the right people are on the right seats on the right bus, that's the time to start implementing your plan. Current performance, potential performance, readiness, and timing. What of these points need to be improved? How are they improved? What needs to happen? Are there training requirements? Perhaps there might be some upskilling of staff. If you're bringing new staff in, they need to be upskilled. That also needs to be considered. We also suggest you would review your organisational structure. Perhaps there is some people who no longer need to be there. Trimming down staff, giving you the ability to then take on other key staff is also vitally important. If you don't have an organisational structure, we certainly suggest you put one on paper. It can start as a simple organisational structure where you're just listing down names, positions people have, a brief description of what they do, job titles, etc. Quite quickly, you'll fill the gaps and realise that you have other needs in the business. The other point to consider internally is family members involved in the business. Some people would argue this is a good thing. Some people will argue this is an area that needs to be improved. What impact does it have on having family members in your business? How do other staff members view these family members? Are there other people expecting a slice of the pie, to say? Is it a given that the family members will simply take over the role of the business and the running of the business? Are they qualified? Are they getting an extra leg up into the business, and what impact will this have on the other members of the team? Is there an opportunity to buy into the business for these other people? Will the family members be buying into the business? If others are buying in and family members aren't, how's that viewed? Is that going to cause any potential issues and conflict? Again, these are all questions that need to be asked when looking at internal. If we shift our focus to external, sometimes external is considered a necessary backup plan. When you've got the ideal world where you're passing your business on to the next generation and that fails either through the next generation not wanting your business or for many other reasons, perhaps external is your only choice. Perhaps your business has grown to a point when your internal people can't afford to buy your business. You've actually created a business that is too successful to the point where it becomes difficult for your internal people to buy. Perhaps you have no choice but to sell to external. External can be used for two purposes: to fill gaps in your internal structure, and by that we mean you may need to recruit others externally into your business to fill those gaps. Recruiting externally to fill the seats on the bus with the right people to complete the overall picture, the structure and the plan. And of course, secondly, it can be used as a source of resource to sell your business or part of the business to achieve your succession plan. If at the conclusion of your internal audit process there is a skill shortage, then externally maybe the fallback position. Importing additional skills sometimes can be needed. Clearly, you'll need to go out into your marketplace and search this. This takes time. It can be a time drainer when you're running your business. Perhaps you need to employ recruitment people to help you. All of these factors also need to be considered. Perhaps you need to recruit for growth. If you're going into a particular area in travel that you haven't embarked on before, is it easy to recruit somebody externally rather than train somebody internally? Identifying a need, recruiting for fit and building a team. If external is needed, starting the process sooner than later is vital. It takes time to build rapport and integrate people into your culture and do it in the way you do your business. You may have some misfires. Not every recruitment works. Sometimes you may need to recruit 2 or 3 times before you find the right person for the right seat on the bus. Again, you need to allow for time for these factors. In summary, there are many combinations of both internal and external that work for all people. The opportunity here is to start the process early, as Steve said. Don't restrict yourself to just one option. Look at all options. All can work effectively, and there may be a combination of both. With that, I'll pass back to Steve to talk about appreciating the essential steps. Over to you, Steve.
Okay, thanks. Okay, appreciating the essential steps involved in developing a strong plan. we really need to be able to, when we're developing or looking at succession planning, we need to separate the business from us as individuals, because at the end of the day, we are going to withdraw from the business. We might not withdraw fully, we might withdraw partially, but at the end of the day, we really need to look at the business itself, really understand where it's going, where it can go. And that's where we're also going to look at who the key stakeholders are in the process. Now, it might be just the family business. Mum and dad might own it. There might be the kids who've got some ownership, but you also might have outside investors. So who can make these decisions on what is to be done? Does everyone want to get out? If not everyone wants to get out, are the people who are not getting out willing to take on the rest of the business? If they are, that might make life easy, except when it comes to the price. But if they don't, and they allow you to sell out, they still might have a say in who the new people who you want to sell out to are. Because at the end of the day, everyone's got to be able to get on with each other to be able to make the business run. Does our family who have probably sacrificed business for the business, have a view of how it should be run out in the future? Again, a lot of the smaller businesses have started from maybe just one person, maybe mum and dad, or just a small group who have put hours and hours and hours into working up this business to what it is today. Some might still be small businesses, others could be quite large. But one of the things you have to do, especially if you're getting rid of all your ownership, is you've got to realize that you've got to let go. You can't hang on to it forever. And this is sometimes the problem, even when you decide, when should I sell out? When should I get out? You should always get out before you start losing interest in the business and it starts going downhill. But by getting out, you also have to accept someone else might want to run it differently. Now, no, especially if you've built a name, you don't want to see that name ruined. But at the end of the day, it's a risk you've got to take. If you want to get some money out of it, and especially for your retirement, you've got to accept the new people might not do it the way you did it. So, do we have the skills in the current team or family members to arrange succession? You know, are the people there? Again, this comes down to, well, do we start employing people to train them up, or take them? They might be trained up, but they might be working in another business who can work on to take that over. Or do we start looking at selling out? Do we sell out to one of the big boys if they're interested? Everything normally can sell at a price. The question is, what are people going to pay? Now, in the past, in many industries, there have been what they call consolidators go out and try and buy businesses. Sometimes they've offered very attractive funds to do it. Other times they try and obviously get the business very cheap. And sometimes they're bought and then the whole group has failed, because every one of these little businesses has been run in a different way, and with the way they want to run it doesn't agree with the rest of the business. So, this step, what are the owner's plans for growth and exit? So, depending, and again, the younger ones, if you want to build your business up to make it a better sale value, you've got to work on that now. And the question is, once you've done that, how are you going to get out of it? Do you want to just sell out, walk out the door once you've sold? Or do you want to say, well, okay, I've worked in this business for a number of years. I've got very good contact both with clients and with providers, which will help any new person coming in. So I will cut down my days. I'll work 4 days, then 3 days, 2 days. That is very vital to whoever the new purchaser is. Some purchasers might just want you out the door. Other ones might say, well, we really want to use you, and so let's work a 2 years sort of thing, phase in, phase out plan. So that is, you've got to determine really first what you want to do. Are you too young to retire? Or, gee, I've just had enough. I just want to walk out the door. And the next one is, how will you, and that's sort of related, how will you manage the transition of the business to the new owners? And again, that's really the same thing. Do you want to work in it or get out? So the next area is discovering the major challenges you'll face and how to overcome them. So consider all the steps involved and assess the weaknesses we have. Do we need a consultant to come and help us? Can we sell this? Can we sell this business by ourselves? Do we know contacts that can help us? Are we looking in the right area? Now, I use an example. A client many years ago was running a serviced office business. They got all these consultants in and business brokers who put all these plans together, and nothing happened. At the end of the day, they found the sale went through, but it was to one of the tenants of the business. And this is really like saying, okay, one of the staff who could have been completely ignored, but if they're doing a lot of the work in your business, they're possibly the best person available to be able to take over the business. Look at the future opportunities that the new world is presenting. Will they aid or crush as we are now structured? Again, that you've got to look at how advanced are you. I know with travel agents, you've all got to have computers because you actually can't make bookings, I don't think, anymore without a computer. But how advanced are you in the industry? I mean, I know many travel agents now, you can still book your hotels through the agency online. The question is, if you're in the dim, dark ages and you haven't advanced, you may not be of interest to a new purchaser because you're just really attracting the wrong crowd. So again, you've got to look at where the travel industry is going compared to where your business is going, and are you going in the right direction to make it look like it's a suitable business? And the other one, then the next is, are we able to have adult conversations with the key players? Now, the example here is children. We've got to start looking at our children, if they are the potential. Well, it's not just my little son or my little daughter who've grown up and I'm still the mother or the father to them. You've got to say, well, okay, can I talk to them as adults as if it was another businessman down the street who I'd be looking at to sell this business? You've got to talk at the same level. You've got to go through the arguments for and against and just really treat them as equals and have proper, honest discussion. Now, obviously, if you're selling to someone outside the family, you don't want to lie to them, but you might, the honesty might not be quite the same. At the end of the day, you're still trying to sell a business, but you obviously also don't want to tell. You've got to be careful you don't get caught. You don't want to doctor figures or anything else like that. But you've got to be honest in what you're doing if you want to try and nurture someone to take over. And the next, and that comes really, what about the mum and dad? It's your baby. Can you let go? You really let go. And I mean, maybe that's the problem, or it can be an advantage when you're selling to, say, your children. Are you still going to try and get your children to try and run the business you were when their ideas are different? You've got to let new ideas be nurtured if it is going to help build that business for the new owner. So just remember, you've got to stand back a bit and you've got to think with your head, not with your gut. And I hand back to Steve.
Thank you very much, Steve. Okay, the next part we're going to touch upon is navigating the tax and structure implications. Appreciating that we don't have all day to talk about this topic, I will be summarising some of the key points. It is probably a full day's seminar just on its own. For most private groups and family businesses, succession planning involves planning for a sale of your business and passing over control to other family members when you retire. Obviously, as part of this process, this may include realising some assets. Retirement planning and estate planning also come into it. As with any type of sale, normally the tax office is then looking for their piece of the sale in form of tax. A sound tax framework can help you manage your tax issues throughout the succession planning process. I guess we always say, as we say to most clients, tax is not always the first priority, but it should certainly be a high priority in all planning. And the same goes for succession planning, retirement and estate planning. Through succession, though succession planning may not have an immediate tax impact, it's important to include tax considerations in your plan. This will avoid any unexpected tax issues that arise down the track when you start to implement your plan. So normally when you start out your plan, the tax office is not going to issue a tax assessment for a liability. It only comes when you sell something. So if we're starting out a plan that we intend to sell in 5 years' time, as some of you have indicated, this tax liability might not be on the horizon yet. But you need to consider it up front because tax structuring and what you do with your business may have tax implications down the track. So not all business structures are well suited to implementing a succession plan. What does that mean? Well, behind all SMEs is a corporate structure of some sort. In most cases, it will either be a proprietary limited or private company with shareholders and directors, but it may also be a trust. And a trust could either be a unit trust or a discretionary/family trust. And perhaps if you could take a minute now to consider what your structure is in light of what I'm about to say. Depending on the assets employed in the business, each structure serves a purpose while running a business. When the business is being sold or transitioned to the next generation, that structure may need some adjustment or some restructure. This can have tax implications, and a close check at the beginning is certainly needed. So which ones work well and when? The short answer is they can all work for their own reasons. For example, companies work well when shares in companies are being sold to an internal or external party to the business. Shares are obviously tangible, they're able to be valued and they're able to be negotiated. Equally, shares can also be passed down to the next generation via a will. So with that in mind, companies work well in most cases. With a company, assets are already contained within the company, so we're not actually physically selling any assets out of the company. In most cases, we're simply selling shares. And provided that the purchaser is happy to take over the company, bearing in mind it comes with all of its liabilities and all its past sins, this is probably the simplest form of transaction. If you look at trust briefly, unit trusts can be considered similar to shares. Units can be valued, and units similar to shares can be valued and negotiated. Also, family trusts work well when assets are being retained in family groups. Although one thing to consider in trust is that we have what we call an 80-year succession rule, which is applicable in most Australian states. By this we mean at the end of an 80-year period, a trust must be vested. And in vesting, there could be capital gains tax implications. So for those who have an old trust, and perhaps they've been running for 30 or 40 years, if you look at the succession where you're looking for the next generation to take over this trust for the next 30 or 40 years, you can imagine at the end of that, there may be that succession planning 80-year rule starting to creep into the end of your plan. This may be then leaving a nice capital gains tax liability for the next generation to deal with. That may not be desirable. Family trusts, due to their discretionary nature, are not tangible. Therefore, it's difficult to sell a family trust. In fact, it's almost impossible. There are no shares or units as a company and unit trust has. If so, and if your current business is in a family trust and you're looking to succession plan outside of your generation, passing down to the next generation, you may be left with no other choice but to shift these assets out of the family trust into an entity that is able to be sold. Or you're left with selling those assets directly to the purchaser. Either way, you may be triggering a capital gains tax event sooner than later. Again, these need to be considered at the beginning of the process, not at the end of the process. So what can you do now to help you later? Well, clearly we need to analyse and understand your current structure and how this intends to transition the succession plan. Both of these are very important points. Capital gains tax, market substitution rules for related party transactions, and value shifting provisions are just a couple of the points in the Tax Act that can catch you out. These can be very technical, and you may need to employ experts, either your current accountants or others, to look at these to ensure you're not falling foul of any of these points. And if you are, you need to understand the timings. Ensuring all tax outcomes are considered to ensure no surprises is very important. The worst case is creating a taxable event now where you may be paying tax earlier, even prior to realising your asset. As you can imagine, having a tax liability with no cash to pay is not a very pleasant situation. And unfortunately, the tax office aren't that empathetic in these situations. These can be avoided through careful planning and discussion with your external accountants. Consider what assets are being transferred to who and when. Timing is everything in succession planning. Change of control considerations and timing is also very important. When does this big event occur? Is it in a year's time, or as some of you indicated, in 5 years' time? If it's 5 years' time, you've got plenty of time to plan. If it's in a year's time, you really need to be looking very seriously very soon. Can estate planning assist with succession planning? Depending on the age of the parties involved and the relationship of the parties involved, through careful estate planning, assets can pass down 2 generations via wills. In this case, taking advantage of various rollover and tax deferrals around estate planning. While we're not touching upon estate planning today, it's certainly something that can be considered as a good way of passing assets down through generations while not triggering large tax liabilities along the way. For example, pre-capital gains tax assets. For those of you who are out there that started your businesses before 1985, you have the luxury of perhaps passing some of your assets down to the next generation while not triggering tax liabilities in that transaction. This certainly needs to be explored and considered if that's the case. So I guess in summary, tax is a very important part. As we said, it's a high priority. It may not be the only priority, but it certainly should be in the top couple of considerations when starting out on your succession planning process. And it should certainly be part of the upfront process. So with that in mind, I might now touch upon business valuation guidelines, which is the next area of focus before passing back to Steve to conclude. Again, business valuations is a whole topic in itself, and we could have a webinar just dedicated to business valuations. So I will only touch upon a couple of the points now just to get the minds ticking. Consider industry accepted methods of valuation. Obviously, we're talking mostly to travel agents today, and I'm sure in your own industry there are acceptable methodologies for calculating business values. In most cases in the SME market, the general form of accepted valuation is a multiple of earnings or a multiple of future maintainable earnings. And by that, we look at the current earnings and perhaps the last 2 years. We also look forward. We then try to smooth out those earnings by taking out any large expenses that may have been considered one-off, or income that may have been considered one-off. We take those out, we ended up with what we call future maintainable earnings. We then multiply that by an industry accepted multiple. In most industries, we always start with industry acceptable multiple of between 2 and 5. My recent research shows that the travel agencies are somewhere between 3 and 5. But again, it will depend on the size of your agency, the assets employed, the turnover you've got, who you're selling to, whether it's internal and external, and whether there's any discounts for selling to internal. Perhaps we're rewarding some loyal members of your team that have been with you for a long time. Perhaps we're going to discount for that. All of those considerations need to be taken into account. So what is consideration, if any, and when will it be paid? Obviously, we have internal and external. If we're selling, in inverted brackets, to family members, will they be paying? If we're selling to internal non-family members, will they be paying? And if they're paying, when will they be paying? Are they paying on a deferred basis, perhaps on an earn-out basis, perhaps up front? And if they're going to be doing that, how are we going to be funding that? Perhaps we're offering vendor finance. Perhaps we're asking them to go away and seek some finance from a financier, such as a bank. All of these things need to be taken into account when looking at any sort of consideration. And most importantly, you as a vendor, if you're taking a deferred consideration, you may have tax implications that come in earlier than when you're receiving your cash. And as I said earlier, the worst possible position is to have a tax liability and no cash to pay for it. So again, that needs to be considered when looking at these points. And of course, intergenerational succession plans. As I said, changing hands and the impact of wills will all have an impact on the business valuations. Core assets versus surplus assets is something to be considered, particularly if you have a company. For example, you may own the property that you're in. You may have assets in there that are not necessarily core assets to your business. These assets may need to be stripped out of the company prior to offering the shares to the internal and external parties. Or vice versa, you may want to sell the business out of the companies and leave these non-core assets in the company for various reasons. There may be tax issues such as stamp duty will also need to be considered depending on which state you're in. But most importantly, you need to start now, be thorough in your planning and make sure this part of the process is a high priority. Too often this process has started too late in the business owner's career, as Stephen mentioned, and many of the potential options are quite often off the table. The earlier you start the process, the better chance you have for a great outcome. And with that, I'll pass you back to Steve to help you create your action plan.
Thanks, Steve. Okay, creating an action plan to move forward. This is more sort of like a checklist of what we have to do. Okay, first of all, identify the desired outcomes and timing. So, what do we want to achieve and when do we want to achieve it? And again, bear in mind, don't leave it too late, because quite often if we leave it too late, we're either going to be stuck in our business for a number of more years than we hope, or we just have to get out and we're not going to get the money we want. Review your current people resources. Who have we got within the business that maybe, well, not only that might take over, but even if you sell out, that whoever purchases would want to use. In other words, they might be, a lot of your assets might be your people. So look at it. Do we have the right people in the right positions? Are we top heavy? Have we got too many people doing very little work, but major wage bills where we're not really getting the right revenue for? As Steve was talking, review your current business structure. Now, you obviously don't necessarily want to change your business structure if you're getting too close to selling out, but you've got to also realize quite often we have people coming and saying, well, should we sell the company or should we sell the business? Now, normally as an accountant, if it's to someone external, you would, if they're buying from someone external, you would say, buy the business. You don't want to be loaded with the company because they're always skeletons in the closet. So, the current business structure can also, as Steve saying, make changes within the tax situation. Share succession plan with the key people. If you want to keep the people, even if you decide you don't want to sell to them, you've got to involve them, because if they walk out and they walk out before you've sold your business will be devalued considerably. Formulate milestones to measure progress. In other words, let's work out a time frame of where we want to go and how we want to get there, and then just tick them off as we go so you know where you are. And that leads to beginning the execution process. You've got to start. Now, the start might be just getting all your information together and putting it in a format, whether it's on a cash pay flow forecast or what, but just get it together so you know what you're going to do. Monitor the progress and check the milestones. Allow for delays and external factors. Now, things happen. They always happen. Whether it's the economy, whether it's something within the family, you've got to, so you might have to adjust your plan to suit those changes. And at the end of the day, do you have a backup plan? What happens if I can't find a buyer? What am I going to do? Maybe there's nothing, but maybe there are other options that you can look at which might be completely different to what you thought of, but it still means you've got something to go on rather than just walking away. So that as I mentioned at the beginning, you will receive later an email. I believe it's going to be sent out about 12:30 today to everyone attending, which will allow a complementary succession plan in discussion with one of our DFK members throughout Australia. So, you know, you will log in and put your details, and then we will refer that to whichever office is the most suitable for you. The initial discussion will be complimentary. Obviously, if you want to take anything any further, that's up to the individual who you talk with and what they charge, but that would obviously be discussed with you. So even if you just want a general discussion, just follow it through. Okay, I'll now hand back to Steve. Steve is our immediate past chairman of DFK Australia New Zealand. I can't think of anyone better to actually just discuss and tell you what DFK is and what we do. Steve?
Thank you very much, Steve. And just on behalf of DFK Australia New Zealand, I'd like to say thank you to AFTA. This collaboration we've had over the last 4 series has been very rewarding for us. We've really enjoyed working with AFTA and talking to everybody on these webinars. So just quickly touch upon what DFK is. DFK, we have a number of clients across a wide range of industries in Australia. We have 14 independent firms around Australia, so a different business model to most accounting firms. We all have our own individual firms. We're in all major capital cities and also in New Zealand. We're also part of DFK International, which is an association of international accounting firms. We have over 200 firms across 90 countries. So if you're looking to expand into Southeast Asia or into any other countries, we can certainly assist there. And as I said, we work seamlessly across all facets of business, working closely with our DFK partners around the world to provide our clients with the best possible service. So how can we help you? Some of the things that we can do, if we flick onto the last slide, strategic planning workshops we do run on a regular basis, similar to these webinars. We can help you with business structure and setting up, looking at those key assets and looking at those non-core assets. How do we get them out of your structure? Business valuations, as I touched upon, is something else that DFK specialises in. Conducting due diligence, so if you're looking to acquire a travel agent, for example, we can help you look to acquire that. Also setting up your business, so doing a review or an audit from a due diligence point of view. Typically, accounting, tax and compliance services is something that we offer. Internal and external non-executive director services is another service, and regular mentoring meetings. So once you've set your succession plan, it's the follow-up. It's ensuring that you're sticking to the plan. We can help you assist in that area. So all of these and so many more services are something that we can offer to you as part of this offering today.
Okay, I'll just add
I'd like to pass that to Steve.
Okay, sorry, I'll just add to that also within a number of our offices, we have a strong expertise in the travel industry. We do a lot of work on travel agents, but also we've done quite a bit of work with AFTA and also IATA. So we've got a strong understanding of the various regulations that cover them. So I'll now hand over back to Joe for questions.
Thanks, guys. Okay, let's have a look and see if anybody has any questions. Okay. All right, we've got a few. This is great. Let's have a look. Oops. Hang on. Stop touching the screen. Okay, so here we've got one. If the business structure is a family unit trust, can it be sold to the external purchaser, or does the structure need to be changed?
Steve, you did that area.
Sure, I can answer that one. So a family unit trust, so I'm assuming it is a unit trust as opposed to a discretionary trust. The units in a unit trust can be sold to a third party. What it will normally require is a fairly high level of due diligence, just given that the person buying the units is stepping into that unit trust, basically picking up any previous liabilities that may exist, and that may be in the form of tangible and intangible claims. And normally what we do in that case, under the business sale agreement or the unit sale agreement in this case, there would be a series of warranties that are signed off by the vendors, basically warranting that they are passing across the units in the unit trust with good title that don't have any, dare I say, skeletons in the closet. And this can also be covered off as part of a legal due diligence, and typically an accounting, tax and legal due diligence all sit side by side. And we would seek a confirmation from the vendor's lawyers that there is no current claims, there's no actions, there's no workers' compensation claims, for example, because when the purchaser steps in, they'll be stepping in and taking over all of those potential claims as well. So I guess in summary, yes, it is possible, but the level of due diligence would be far greater than if you were selling the business assets out of a structure like that. So really it just comes down to a negotiation point.
Can I just add to that, Steve? Oh, sorry.
No,
Can I just add to that? It's pretty well similar to if you were selling the company rather than unit trusts. The due diligence would be similar, but the only additional thing that may crop up with a unit trust is if it's got a trustee company, you would also presumably be selling that trustee company, or you might be selling that trustee company, which means you've also got to do due diligence on the trustee company. Sorry, Joe.
Correct.
I just was going to ask, what about discretionary trusts? Are they also difficult to sell?
Discretionary trusts are almost, I'd say, impossible to sell. The reason is that discretionary trusts have a trustee that then typically is a family trust, and we don't have any tangible equity to sell. So it's not like having shares in a company or units in a unit trust. So in most cases, a discretionary trust would be selling the assets out of that trust. The purchaser would then be buying those assets and putting them into a company, a unit trust, or perhaps another family trust. But because of the family trust nature of a discretionary trust and the way that the taxation of a family trust works, it isn't possible to buy a discretionary trust, just given the nature of the asset and how it works.
And is it part of your core business to assist, I guess, even travel agents to sell their business? Is that something that is a core focus of your business?
So with the sale of the business, we don't actually broker, so we're not sales brokers. We don't have a broker's license as such, but we certainly assist with setting up businesses for sale and assisting with the marketing and also the due diligence process. Steve, do you want to add to any of that?
Yeah, I think you both said it, but again, being in the industry, if we know of someone who might be looking, we might be able to steer them in a direction to a particular another travel agent business. Or we sometimes have clients who say, "Oh, I'd really like to try and get into buy a business," but that's really just the luck of the draw, what's available at the time.
Okay. And then I also had a question here just asking, how do you find external, hang on a sec, I've just lost the question. Where are we? How do you find an external buyer? Like, what are the best ways that you might be able to go about finding it if you're ready to sell your business? Is there any top tips?
Look, I don't think there are any distinct brokers. I might be wrong within the travel industry. But I don't know, you'd have to do a bit of research. Off the top of my head, I can't think of anyone in particular. But, it's the question, and probably some travel agents would probably know better than anyone else if they hear talk around in the industry of people who are looking to buy. I mean, Otherwise, I suppose you just got to advertise. There are business brokers. To be honest, in a lot of the times, they're not necessarily that good. As I said, unless you can find someone who's really specialising in the travel industry.
Okay.
Steve, you got anything more to add to that?
No, I'm not aware of any specialised travel industry brokers. However, as you said, business brokers would be the first option, and then word of mouth in the industry would be my second option. I think the most important part is that the preparation of setting up a business needs to start sooner than later, and then once we're ready to sell, finding that market out there is where you would be engaging external help.
Okay, thank you. Let's have another look. We've got a couple more questions here. We do have a question on total turnover. And the question was, can you be more specific with regards to the value of a business, as in travel agency, with regards to TTV or net income? So, like, is there a formula? This might be a bit complicated. Is there a formula to determine a business's worth? And is, for example, their database worth anything?
So there is a number of databases out there and financial models that look at various industry sectors. This is something that, as part of a due diligence process and a business valuation process, we would be looking at. So there is a number of, as I said, accessible databases. I did quickly run a typical model just to get some idea of those multiples that I talked about earlier. Again, it depends on the turnover of the business, the number of staff, the location of the business. There's a series of factors that go to determining that multiple. And as I said, it is a bit of a broad range. It isn't a science. It's more of probably of an art, and it does come down to negotiation. But from what I saw, turnover of more than $1 million was in that 3 to 5 times multiple. And as I said, that's just a guide. It's really just a starting point, not an ending point. And there is no hard and fast formula that says type this in and type this in, it'll give you a value, and that's what you'll realise. At the end of the day, selling anything is a negotiation process. This is really meant as a guide.
Right, okay, helpful. And what about the business's own client database? Is that considered in the mix? How strong their relationship with the customers and the extent of their database?
Definitely. If I was undertaking a due diligence of a travel business, I'd be looking at the strength of the relationship that the business owners have with the customers, how they communicate with their customers, how they market to their customers and clientele. And sometimes it actually has the reverse effect. If the key person in the business has extremely strong contacts and that person is taken out of the business, what is going to happen to that goodwill? What is going to happen to that customer base? Will they take that as an opportunity to go and talk to new travel agents, for example, or will they be loyal enough to the business model that has been built to enable the new person to step in? Obviously, being very much a relationship-based business, the rapport that new person builds quickly with the existing customers is going to be vital. And in fact, I would say that the new person would be embedding themselves into the business prior to the sale transaction, and the previous owners helping with that transaction to realise the best value of that goodwill. If we simply finish on a Friday and start on a Monday with 2 different business owners, is that personal goodwill that remains with that previous owner going to stay with the business, or does it go with that previous owner? And that is a big factor when looking at the value of the business and looking at what you're actually buying.
Okay, thank you. We have a question on tax outcomes. And this individual is asking specifically what you're referring to and what types of tax bills do they need to be aware of or alerted to? You mentioned capital gains.
Sure. So capital gains is a big one, particularly when you're selling an asset. If you've got internally built goodwill, so you've started the business from nothing, and you're now selling your customer book, as we were just talking about. That customer book is goodwill, so it's an intangible asset that comes with tax implications. Now, there are, without going into too much detail, there are a lot of small business concessions that can help you minimise your tax. There's also what we call a general discount available for capital gains. So each one is taken on its merit. But yes, there is tax on the sale of goodwill. There's also potential tax sale on the sale of plant and equipment. If you've depreciated your plant and equipment, for a quick example, you've got a $100 computer, you've depreciated it down to $20 and you sell it for $40, that additional $20 increase is still taxable. So that's something that needs to be considered. So plant and equipment is typically sold. The intangible asset, which is made up of not only your customer base, it's also made up of the business name, all of the marketing all the marketing material you may have. Basically, the culture of the business is all wrapped up in that intangible number, which is subject to capital gains tax. When is the tax payable? Well, typically it's payable in the year following the year that you sell your business. If you were to sell your business now, it's taxable in the 2017-18 financial year. So you're not going to be paying tax on that until you lodge your tax return for the 30th of June 2018. So in that case, you've probably got a 12 to 15 month window where your tax will be due. For example, if you were to sell your business on the 30th of June, you've got a very short period when your tax is due, because shortly thereafter your tax return is going to be due for that year. So a big part of the succession planning plan is to understand your tax liability, and most importantly, when it's due. And then is there things that we can do to minimise our tax prior to the 30th of June, such as superannuation contributions, etc., that can help minimise that tax? Because once you fall into the new financial year, there's really not a lot more you can do about the previous year's tax liability. So it's just understanding the timings of your tax.
Fantastic, Stephen. Thank you. Well, we've now come to 12 o'clock, so we might wrap it up there. Guys, is there anything else you want to add before we conclude the webinar?
No, I think just thank everybody for joining us. And as I said, they've got this free consultation, which will be sent to them within, I think, the next half hour, if they want to act on it.
Perfect. Well, on behalf of
thank you very much.
Thank you, Stephen. On behalf of AFTA, it's been really great to have DFK hosting this webinar series. We've done a lot of webinars on marketing, so it's really nice to switch our focus back to savvy business operations and really understanding things like cash flow and profitability and succession planning. So thank you for hosting the webinars. If anybody wants to refresh any of the webinars we've had, you can. All that information is on the AFTA website, as well as the contact details for DFK to find out any more information. And as Stephen has just said, you will receive an EDM, an email with details on how to claim a session on succession planning. So thank you very much, everyone, for your time this morning.
Thank you. Bye.
Bye-bye.